Hi everyone, this is Saravanan and Balakrishnan again. So I've been back after 3 months to post my next video. So this video is going to be about contrarian thinking. So last 3 months back, I posted a couple of videos about different companies, as well as in terms of general outlook that has panned out across the Indian markets. Today, I wanted to mainly focus on some important aspects that was useful for me during the last bear market in 2018. So if most of you remember, in 2017, so market almost reached all-time high in December 2017, along with the cryptocurrencies like Bitcoin. Most people wanted to quit their full-time jobs to sort of start something with regard to stock trading as well as investing in cryptocurrencies. Mostly you can draw some parallels in terms of people wanted to get rich quick soon. So what I find right now is that there are some parallels which are applicable to Indian markets right now. So couple of things, mainly in terms of the mood of the markets as well as in terms of how the retail investors are behaving. So I see a lot of trends, or maybe telltale signs, if I might want to call it, which indicates that there is something worse that is yet to come in terms of the massive action that has happened in Indian stock markets over the last 15 odd months. Here are some reasons why I tell that so. So now, if you see, right, Sensex almost it's just 1,000 points at all-time high, and almost if I see any company, uh, they are almost trading at historically elevated valuations, 100 p, 200 p, and most people wanted to rationalize buying even quality companies at any price, right? Which historically was not highly relevant, and also doesn't justify the underlying profits that these companies are making. Second is, in many companies, the promoters who are running the companies are actually selling their existing shares. So where you can see quarter on quarter their holdings are coming down, which clearly says that the promoters are not as confident as the retail investors think they are about the business. And number three, there are multiple rights issues and stock splits, which are again done at a very high valuation, which investors think that they seem to be value unlocking for the minority shareholders. And number four, commodity prices are at all-time high. When even when most of the central bankers, they say that the inflation is transitory, but I don't think that's the case. Even food inflation uh, is going to go high skyrocket, where fertilizer prices have almost reached an all-time high, which was not seen for the last 10, 12 years. So I think we are yet to see that, and even interest rates are remaining at all-time low. So all these combinations have made ensured that the liquidity in the system is sort of high, right? And also mutual fund flows and mutual fund managers buying IPO stocks with no earnings. I think all of this is not a good sign, and these things didn't happen last year. Where in last March, when I told people to buy stocks, so I think most people asked me that if I have gone mad. But now it's the exact opposite, right? If I tell them not to buy, they are going to buy that. So this is how the sentiment has shifted from depression to a sort of euphoria, which usually happens, right? Graham once mentioned that stock markets swing between two extremes. One is depression and euphoria. So right now, the current market is euphoria, where I see a lot of IPOs that are getting launched at exorbitantly high valuations, which doesn't justify that. But still, retail investors, they borrow money and invest in them. Even I know one of my friend who has got his father's retirement money to invest in IPOs, right? So people wanted to venture, taking unnecessary risk, where they could end up losing their permanent capital, right? So now, keeping all of this in pointer, what becomes more important is that equity is not the only asset class to invest. So there are multiple asset classes like debt funds, and also again other commodities. which might tend to perform well, right? Where they have been a laggard for almost a decade right now. So where there are green shoots where things could again change in terms of how the market cycles move. And second is again refraining from investing in overvalued stocks where there is no margin of safety and we'll end up losing our own capital. And number three being is that uh, understanding your risk appetite, right? Not all of them are high risk, not all of them have a high risk appetite. So it's important for you to know what's your level of risk appetite and also doing asset allocation, right? In terms of what age you are at, as well as your near term goals and other things. You need to factor in all of this pointer before investing in stocks. And the most important part is going directly through mutual funds. Most people wanted to directly invest in equities, which is completely fine, but not all of them will have time to sort of study the annual reports and understand the management business, doing a lot of analysis before taking a judgment call, where even after doing all of this analysis we can sort of make error, right, in judgment, where we could end up losing money. But when we go through mutual funds, the risk is much lower. So keeping all of this, so now it's the time for us to exercise caution and stay away from stock markets. And even if you're investing through stock markets, invest money that you can afford to lose, which doesn't impact your day-to-day life. Markets are elevated, investment bankers are happy. I spoke to some of my friends where they are happy about multiple IPOs they have launched, and they've been getting a huge bonus. And this is being sold to the retail investors, but retail investors hardly understand the business in every cycle. And the FIIs always teach the fundamentals of investing in every market cycle, right? So stay safe, and so don't buy into any Diwali stocks that are being announced in different media channels nor Twitter. So it's your money, your conviction, your risk, and your reward. With that note, I hope you're safe, and see you for the other video.